Hi there, welcome to a micro video. Let's spend a few minutes thinking about the concept of disequilibrium in a market. Now, the market clearing or the equilibrium price is where the quantity supplied and the quantity demanded are in balance, as is the case in this example in the oil market, where supply and demand are in equilibrium at price P1 and output of Q1. But disequilibrium occurs when the price of a good or service is not at the level where quantity supplied equals quantity demanded. In other words, there is a deviation from the equilibrium. Key aspects might be, for example, excess supply, there's too much of a product, or excess demand, there's a shortage, because there's a misalignment between supply and demand in the market. Now, disequilibrium prices are often temporary. They don't have to be. Markets tend over time to adjust towards equilibrium through changes in price, changes in supply or demand, or all of them. So what are some of the main causes of disequilibrium in a market? Well, oftentimes it's the government through intervention. They might impose a price control, some form of capping. A good example there would be rent control in the housing market that prevent prices from rising to equilibrium. And if you've studied rent controls, maximum prices, you'll know that the theoretical expectation is that capping the price leads to shortages. Nearly always, though, disequilibrium is caused by market shocks. These are unexpected, sudden changes in either demand and or supply, often due to external events. The impacts of climate cannot be denied anymore, and natural disasters affect the markets for many agricultural and farm goods. Technological innovations can cause shocks. And of course, health crises. So a sharp increase in demand for masks during the pandemic creates a shortage if prices did not adjust quickly, and they didn't. What tended to happen, of course, was that supply responded over time. We can get disequilibrium because of imperfect information, so buyers and sellers may lack the full, complete information about market conditions. A producer, for example, might overestimate demand and sets prices too high, causing a surplus. And if you've studied Keynesian economics, you'll come across the idea of sticky prices. It's just the case in markets that prices are often very slow to adjust to changes in supply and demand. There are costs involved in changing prices, menu costs, for example. Contracts are enforced and have to run their natural life. Behavioural factors can cause sticky prices in markets. So disequilibrium can happen when the price is deviated or misaligned from the equilibrium. Here's a good example where the price at P2 is too high. And at price P2, quantity supplied will be Q3, but demand will be Q2. There'll be a surplus in the market. And in that situation, there will be unsold inventory or stocks. And typically we expect to see sellers lowering their prices or cutting production to clear the surplus. So a good example there might be the farm surpluses we typically associate with guaranteed minimum price floors. Equally, you can have a disequilibrium where the price is too low relative to the equilibrium. In this case, P2. And at P2, quantity demanded is Q3, quantity supplied is Q2. There is excess demand or a shortage. So this is where demand exceeds supply. And in this situation, we expect to see queues and waiting lists, perhaps some form of rationing, or indeed black markets may emerge, shadow markets to sell goods at higher prices. And the example there will be things like a rental housing shortage due to maximum rents. Now, at any given moment in time, most markets, I would say, in fact, nearly all of them may be in a state of disequilibrium. The equilibrium is constantly changing anyway, and markets are reacting to various factors and forces that influence supply and demand. The entry of new products, new services, new technologies can be a key factor here, disrupting the existing market and creating a temporary disequilibrium. But I think it's important to note that if you believe in market forces, if you believe in the price mechanism, markets naturally tend to move towards equilibrium over time, because the participants, producers and consumers, respond to changes in the market. So producers adjust their output levels, consumers change their spending, and that's the way that the market gravitates. However, the time it takes to reach a new equilibrium can vary. It doesn't happen instantaneously necessarily. It does in markets like foreign exchange, for example, but typically in real-world product markets, the time it takes to reach a new equilibrium price and quantity can vary, and that depends on the market's responsiveness to these changes. So it's worth understanding, for example, the price mechanism, the signalling, the rationing and the allocation function in understanding how a market moves out of disequilibrium towards a new equilibrium. Okay, I hope you found this video useful and helpful. Thank you for joining in, and see you sometime soon.